Welcome to our video on how to invest in index funds. In this video, we will provide you with a comprehensive guide on what index funds are, how they work, and why they are a great investment option for both beginners and experienced investors. Index funds are a type of mutual fund that tracks a specific market index, such as the S&P 500 or the Nasdaq. They are designed to provide investors with broad exposure to the stock market while minimizing risk and fees. In this video, we will cover the following topics. What are index funds? How do index funds work? Why invest in index funds? How to choose the right index fund for you. Tips for investing in index funds. So, whether you are new to investing or looking to diversify your portfolio, this video will provide you with all the information you need to get started with index funds. Index funds are a type of mutual fund that tracks a specific market index, such as the S&P 500 or the Nasdaq. The goal of an index fund is to replicate the performance of the index it tracks. This means that if the index goes up, the value of the index fund will also go up, and if the index goes down, the value of the index fund will also go down. Index funds are passively managed, which means that they do not require a team of investment professionals to actively manage the fund. Instead, the fund simply tracks the index it is designed to follow. This makes index funds a low-cost investment option, as there are no high fees associated with active management. Index funds are also highly diversified, as they hold a large number of stocks that make up the index they track. This diversification helps to minimize risk, as any losses in one stock are offset by gains in others. Overall, index funds are a great investment option for those looking for a low-cost, diversified way to invest in the stock market. Index funds work by investing in the same stocks that make up the index they track. For example, if an index fund is designed to track the S&P 500, it will invest in the 500 stocks that make up the S&P 500. The value of an index fund is determined by the performance of the stocks it holds. If the stocks in the index go up, the value of the index fund will also go up, and if the stocks in the index go down, the value of the index fund will also go down. Because index funds are passively managed, they have lower fees than actively managed funds. This is because there are no investment professionals actively managing the fund, which means there are no high management fees. Index funds are also highly diversified, as they hold a large number of stocks that make up the index they track. This diversification helps to minimize risk, as any losses in one stock are offset by gains in others. Overall, index funds are a simple and effective way to invest in the stock market. They provide broad exposure to the market, are low cost, and highly diversified. There are several reasons why index funds are a great investment option. 1. Low fees. Index funds have lower fees than actively managed funds, as they do not require a team of investment professionals to actively manage the fund. 2. Diversification. Index funds are highly diversified, as they hold a large number of stocks that make up the index they track. This diversification helps to minimize risk, as any losses in one stock are offset by gains in others. 3. Broad exposure. Index funds provide broad exposure to the stock market, as they track a specific market index. This means that investors can benefit from the overall growth of the market. 4. Easy to invest. Index funds are easy to invest in, as they can be purchased through a brokerage account or through an employer-sponsored retirement plan. 5. Consistent returns. Over the long term, index funds have consistently outperformed actively managed funds. This is because actively managed funds have higher fees and are subject to the biases and emotions of investment professionals. Overall, index funds are a great investment option for those looking for a low-cost, diversified way to invest in the stock market. Here are some tips to keep in mind when investing in index funds. 1. Choose the right index fund. There are many different index funds available, so it's important to choose the one that best fits your investment goals and risk tolerance. 2. Consider the expense ratio. The expense ratio is the annual fee charged by the fund to cover its operating expenses. Look for index funds with low expense ratios, as this will help to maximize your returns. 3. Invest for the long term. Index funds are designed for long-term investing, so it's important to have a long-term investment horizon. This will help to ride out any short-term market fluctuations. 4. Don't try to time the market. It's impossible to predict the market, so it's best to invest consistently over time rather than trying to time the market. 5. Rebalance your portfolio. Over time, your portfolio may become unbalanced as certain stocks perform better than others. It's important to rebalance your portfolio periodically to ensure that it remains diversified. By following these tips, you can maximize the benefits of investing in index funds and achieve your long-term investment goals.